So our role is to give shareholders really intelligent and thoughtful exposure to opportunities that sit outside the areas that have done very well, and frankly, they can access pretty quickly.
Hello, you're watching Proactive. Joining me is Dan Higgins, manager of Majetti Investments. Dan, very good to speak with you. What makes Majetti's investment strategy different?
Well, I think what makes us different is we combine differentiated fundamental return sources in a way that hopefully creates good long-term absolute return potential, but also means that Majetti acts as a source of diversification for its shareholders. So we've spent most of our careers scouring the world, trying to find the best opportunities under the surface of markets. And we believe that's going to be more important than ever. We have three different ways of investing, put them all together, and we hope we can deliver a really good and differentiated outcome for our shareholders.
Dan, could you explain the three complementary strategies, please?
Yes. So the first, which is the largest of the three, we call external managers. And as the name suggests, we source, identify, and evaluate a relatively small number of the world's specialists in niche fundamental areas. So within equities, that might be in areas like mid-cap biotech or Japan small cap activism or deep value European stock picking. And then we also allocate to specialist credit strategies, which include stressed and distressed debt, which is a nice counterbalance to the equity component of the portfolio. Most of the managers that we allocate to are completely off the radar screen of other investors. Many of them are closed or hard to access. We can access them by virtue of our historic relationships. And all the investments in our portfolio are there to deliver good long-term absolute returns. So external managers, about 60% of the portfolio today. And I have to say, although it's a very difficult time for markets and global economies and on the political front, what we're seeing under the surface of markets, this rotation out of a lot of the consensual areas into off the beaten track areas, we think that's terrific for the managers that we've selected from Majetti. The second part of the portfolio, direct investments. Our team selects a relatively small number of stocks in-house, about 10 to 12 stocks, something of a quality growth bias to it. But again, these are names you won't find in other people's portfolios. We've been finding more and more of the best opportunities in Europe, the UK, and Asia. And then the third part of the portfolio, special investments, that I think is the most differentiated of three differentiated strategies. And here we are given the opportunity a few times each year to invest alongside some of the world's greatest investors in their highest conviction ideas. So co-investments in public securities, often with an activist angle, thematic opportunities, or completely idiosyncratic, uncorrelated situations. We have three criteria for special investments. They must come from a trusted source, high return potential. So we're looking for returns of 20% a year or more. So that's pretty ambitious. And we must feel that we can capitalize on them or monetize them within 3 years or less.
Could you explain the liquid endowment approach?
Yes. So we've coined this phrase liquid endowment. What do we mean by it? Well, the endowment part means that we emulate the philosophy and the mindset that has been so successful for the elite university endowments, especially in the US over many years. By that, I mean we're very long term. We're very fundamental. We don't engage in market timing. There is nothing in our portfolio that is a low return expectation asset that is merely there for diversification reasons. And we're willing to seek out and harness differentiated and sometimes alternative return sources. So that's the endowment bit. But again, the clue's in the name. The liquid part tells you that unlike many of the elite university endowments, we do not drift into deeply illiquid strategies like private equity or venture capital or real estate or infrastructure, partly because other people do that very well. It's not our particular area of expertise, but partly because we just don't feel it's necessary to lock your money up for 5, 10, 15 years in order to generate superior returns. And I think when we took over management of Majetti, a couple of years ago, we never could have understood how important that aspect was going to be, that everything in our portfolio is marked to market regularly. It's not dependent on leverage. And so the NAV, the net asset value of the fund, shareholders can really have confidence that it's a real number. It's not a conceptual one.
What's a special investment and how does it differ from a direct investment?
So direct investment, put simply, is just an investment in a publicly listed security that we own directly rather than through an external manager. And we're very conscious of the areas where we feel we have a competitive advantage that's in our sphere of competence, and those areas that are best left to the experts. So we're very happy to invest in good quality companies with strong management teams, good balance sheets, listed in the developed markets. You will not find us rootling around for ideas in China, A shares, or emerging markets. Special investments are much more idiosyncratic and situation specific, and very often they are episodic. So examples that we've pursued so far from Majedi would include an activist campaign in the public equity of Shake Shack, the US listed burger restaurant, which has a great franchise, a great brand, but it had been managed by a management team that was used to running high-end Manhattan fancy restaurants rather than quick service restaurant format. And the group who bought us that idea believed that the company could really live up to its potential if they focused on cost control, centralized buying of ingredients, lowering the unit price of delivering product to customers. We invested in the senior non-preferred bonds of Metro Bank when Metro Bank got into a bit of difficulty a year or so ago. Through a distressed debt manager we know in London, we were able to invest alongside them in the safest part of that company's capital structure that did really well when the bank got restructured. More recently, we've invested through a New York-based firm in the public equity of CVS Corporation, the big US-listed healthcare company. We've just done a litigation finance opportunity. And so, as you can tell, it's a very eclectic mix. We're not originating these ideas. They come to us through our trusted network. Our job is to vet the idea, vet the person who's brought it to us, and then allocate with conviction. And our shareholders know that we've done a lot of the heavy lifting and the diligence for them.
Dan, why should Majedi be considered for inclusion in an investment portfolio?
I think the reason that Majedi should have a role to play in an investment portfolio is really threefold. So first of all, it reflects on the investment regime that we're now in. For 15, 20 years, interest rates have fallen, markets have generally speaking gone up, and the most important criterion for most investors is to be invested. We think most markets look pretty fully valued now, and there's a very good chance that the things that have worked well over the last 10 to 15 years won't work as well in the future. So put simply, you're not going to get as many tailwinds as you have. We can't assume that markets always go up, that the US always outperforms everything else, that a small number of mega cap growth stocks always outperform all other kinds of investments. We can't assume that the dollar always outperforms every currency. So our role is to give shareholders really intelligent and thoughtful exposure to opportunities that sit outside the areas that have done very well, and frankly, they can access pretty quickly. The second reason I think we have a role to play is just the investments in the portfolio. You won't find them anywhere else. And that's really important if we're going to justify our existence. And the third is we're really aligned with shareholders. So we get incentivized or remunerated on market capitalization, the share price, not the NAV. We have our own money invested alongside our other shareholders in Majedi. So our interests coincide with yours. And I think that's more important now than it ever has been.
And how do you measure your success?
Very simply by the share price, which of course is directly or indirectly related to the net asset value. The official objective of the trust is to deliver returns that beat inflation by at least 4% annualized over 5-year rolling periods. Still relatively early days. We're 2 and a bit years in, but so far we're well on track to do that. It is important that we're measured over a sensible time horizon. So we say 5 years. Of course, 5-year periods are made up of shorter periods than that. But ultimately, our success reflects whether our shareholders are happy with the job we've done for them, and that means has the share price gone up or not. So as well as hopefully doing a good job from an investing perspective, we also have to make sure that word gets out there and Majetti's shares don't trade at a big discount to NAV. And that's a communication issue, and to make people aware of the relevance of Majetti and the role that an investment trust can play in the world today.
Dan, I hope you'll keep us updated on your progress. Thank you very much for the introduction today.
Great. Thanks for having me.
That's Dan Higgins, manager of Majetti Investments.